Now let's discuss about the annual allowance. So, as we have discussed that the relief is lower of gross pension and the annual maximum amount, and the annual maximum amount is the higher of the relevant earning and 3600. Now, if total pension contribution exceed the amount of annual allowance, each year there is an annual allowance of 40,000. So if total pension contribution exceed this annual allowance, then a charge is made on an individual. That means that if the gross contribution exceed the annual allowance, then we have to pay tax on the excess value. Then it means that we are getting relief on contribution, but sometimes you have to pay tax on contribution. So the current year tax annual allowance is 40,000. Now, this annual allowance can be increased as well by using unused allowance of the last 3 years. It means that in the previous 3 years, if the 40,000 limit is not being utilized, assuming the limit is same, if that limit is not being utilized, then that limit can be carried forward. You can carry forward of the last 3 years unused allowance. But in order to carry forward the unused allowance, the person must be registered for a pension scheme. And the order that we have to follow is first in, first out. That means earlier year unused allowance to be used first. So first we will consider the current year annual allowance, then we will consider the unused annual allowance in the order of first in, first out. Now let's discuss the example. For example, we have gross pension contribution in the year 15-16, 16-17, and 17-18. That is 50,000, 30,000, and 18,000. Now, relevant earning per annum is 100,000. Calculate total allowance available in 18-19. Remember, 18-19 allowance is 40,000. Now we'll calculate the unused allowance first. So as far as the 15-16 value is concerned, let's check, is there any unused allowance? So the contribution is greater than 40,000. So that means there is no unused allowance. While in 16-17, the contribution is less than 40,000. So we have unused allowance of 10,000. That is 40,000 minus 30,000. While in 17-18, we have unused allowance of 40,000 minus 18,000. That means 22,000. So we have unused allowance 32,000 for the last 3 years. Now we have allowance of current year, and that current year allowance is 40,000. So now we have total allowance available in the current year is 72,000. Now what is the use of this 72,000? It means that if we contribute gross pension up to 72,000, then there will be no tax on it. But if our contribution is greater than 72,000, then we have to pay annual allowance charge on it. Now let's discuss what is annual allowance charge. AA charge. Where total contribution, say suppose total contribution is 60,000 and your annual allowance is only 40,000, then this excess would attract an annual allowance charge. So we have a tax charge on 20,000. Now how this amount will be taxable? So this tax charge or this amount is considered to be taxed after all source of income, that is your saving income, non-saving income, and dividend income. And the rate that would be applicable at the rate of non-saving income. That means there are likely chances that the maximum rate of 45% will be used, but it depends on the level of other income. It might be 20, it might be 40, or it might be 45%. Now let's take an example. Tax adjusted profit is 105,000 and gross pension contribution is 90,000 into a personal pension scheme in the year 1890. There is no unused annual allowance. So that means we have only 40,000 allowance available. So let's find out, let's calculate the income tax liability. Now, first of all, let's see that we have gross contribution exceeding the annual allowance, and we have gross contribution of 90,000, and we have annual allowance of current year is only 40,000. So the charge would be applicable on 50,000. This is excess. Now we know that we have to apply tax on this charge. Now let's find out the taxable income first. We have tax adjusted trading profit of 105,000. So let's work it out. Tax adjusted profit 105,000. Now deduct personal allowance. As we have personal pension contribution, so full personal allowance will be available. The remaining value is 93,150, and this is taxable income. No need to find out ANI as it will be less than 100,000. Now let's calculate income tax liability. So we have to apply non-saving income. Now we know that if there is any personal pension contribution, then the band would be increased. So let's find out the band. So our tax band would be available to, like, basic band is 34,500. So we'll add 90,000 of contribution. It would become 123,4. It would become 124,500. The second band would be 124,501 till 1,50,000 plus 90,000, that is 2,40,000. So this is the band. As we know that if there is any pension contribution, that is gross personal pension contribution, then you have to extend your band, basic rate band and additional rate band. Now, so let's work it out again. So we have our non-saving income, and that is 93,500, and our band is basic band end at 124,500. So we can say that 93,150 multiplied by the basic rate 20%, and that is 18630. So we have covered our non-saving income, but we have AA charge, and that AA charge is 50,000. So if I add 50,000 in 93,150, that will exceed my first band. So that means how much space is available in my first band. So let's explore 124,500. So my AA charge partly my AA charge would be 31,350, and it would attract first rate, the basic rate 6270, and then my remaining AA charge out of 50,000 would fall in the second band, and the rate would be 40% as it's a non-saving, considered as a non-saving income, the type of non-saving income. So my total tax liability is 32,360. In this way, we have covered our AA charge. Now let's discuss that whether this annual allowance might be reduced as well, whether it might be reduced or not. There is another rule that is called reduction of annual allowance. The standard annual allowance for current year is 40,000. It might be increased due to unused carried forward allowance, but sometimes the annual allowance might be reduced. And it is possible when an individual is having high income. So what is the definition of high income? So for this, this is applicable when threshold income is greater than 110,000 and adjusted income is greater than 150,000. As far as the paper TX is concerned, this threshold income concept is not examinable. So we'll focus on the adjusted income. Now, how we can calculate adjusted income? The formula for calculation of adjusted income is, this is not the ANI, is different. The formula for adjusted income is, we have to find out the net income, and from net income we will add employer contribution in any scheme. Remember, employer contribution in any scheme, whether it's personal or occupied, and individual employee contribution. But this employee contribution is only occupational contribution. So the rule is that you can add employer contribution, any employer contribution, but as far as the employee contribution is concerned, it will be only the occupational part. There is no personal pension contribution that you will add in net income in order to make it adjusted income. So in this way, you can find out your adjusted income. For example, let's assume that the adjusted income is greater than 1,50,000. Now what? If your adjusted income is greater than 1,50,000, then your annual allowance will be reduced. And the working is similar to the working of personal allowances. What you have to do, you have to consider the adjusted income. For example, say suppose let me take an example. Adjusted income is 1,60,000. Take this. So what we have to do, take adjusted income, compare it with 1,50,000, find out the excess value, multiply by 50%, and the half value, that is 5,000. This is reduction in annual allowance. So in this way, the reduction can be found, and you can find out how much allowance is available. So, but one thing you should remember, that the maximum reduction is up to 10,000. What it means? It means that the annual allowance cannot be reduced more than 10,000. So if adjusted income is 2,10,000 or more than that, then AA would be 10,000, as it is restricted. Now let's find out a question. We have employee contribution, and that is occupational, and we have employer contribution, and we have taxable employment income, A, B, C. We have three employees, A, B, and C. So the contribution is 30,000, contribution is 8,000, contribution is 12,000. Here contribution is 5,000, 2,000, and 20,000. And the level of income is 1,60,000. There is no source of income other than that. Calculate the annual allowance for each of the employees. So let's work out for each employee one by one. So as far as the employee A is concerned, let's find out the adjusted income. So net income is 110,000, and you have to add employer contribution, that is 5,000. Also employee contribution, that is 30,000. In this way, we'll get a value of 1,45,000. As this is less than that, so the available allowance is 40,000. Now, the second employee is concerned, B. So we have taxable employment income 2,20,000. So we have net income 2,20,000, and we have employer contribution as well as employee contribution. Let's see. Employer contribution is 2,000 and 8,000, that is total 10,000. This is 2,30,000. As we know that if the adjusted income exceeds 2,30,000, then the maximum reduction, we can use the concept of maximum reduction. So annual allowance is 40,000 minus reduction. So reduction is 230,000 minus 150. In this way, the difference is 80,000, and it's multiplied by 50%. So that means our reduction is 40,000, but the double A is restricted up to 10,000. So we'll use 10,000. Now, as far as the third employee is concerned, its taxable employment income is 160. So taxable employment income is 160,000, and to add employer contribution, and that's employer contribution is 20,000, and employee contribution, that is 12,000, becomes 192,000 total adjusted income. Now let's work out. Annual allowance value is 40,000, and we can use. So the annual allowance is 40,000. Now let's work it out, the reduction. So our adjusted income is 1,92,000. Threshold is 1,50,000. So the excess amount is 42,000. Multiply by 50%, that becomes 21,000. And after reduction, the reduced double A annual allowance is 19,000. So we'll use this 19,000 in order to compare that whether there is an annual allowance charge or not.